Corporate exit is the most consequential founding situation because three different things break at the same moment. The corporate paycheck stops on a known date. The corporate health insurance stops on the same date or shortly after. The corporate retirement plan contribution structure changes the day employment ends. All three have hard windows attached to them. All three have severe consequences for missing the window. And all three have to be sequenced before the entity formation work even begins. The default founding map starts at step 1. The corporate exit map starts before step 1 with 4 exit window decisions that have to be handled first. 3 things break at exit, and missing any of the windows compounds for years. Income stops on a known date, usually the last day of the pay period after the formal exit. Health insurance stops on the date the employer determines, usually the end of the month of separation, sometimes earlier. Retirement contribution capacity changes. You can no longer contribute to the corporate 401k. The employer match stops, and the rollover decision opens. All three are hard transitions, not soft ones. Walking past any of them creates either uninsured exposure or uncovered cash gaps or tax disadvantaged retirement positions, all of which cost more to fix later than to handle on the timeline. 4 time-bound decisions get sequenced before the entity formation work begins. Step E1, severance timing. Step E2, COBRA election window. Step E3, 401k rollover decision. Step E4, cash cliff management. Each one has its own deadline, its own owner, and its own dollar consequence for missing the window. After all 4 are handled, the corporate exit map falls back to step 1 of the default sequence. Most exiting executives think about the entity decision first, because that's the starting of business framing. The map reverses that framing. The exit windows come first because the windows are short, the consequences are durable, and the entity decision can wait 2 weeks. Step E1 is severance timing, and the bracket math can be brutal. Stack severance plus partial year W-2 from the corporate role plus first-year coaching revenue all in the same calendar year, and your effective rate spikes. The qualified business income deduction phases out above certain income thresholds. Module 15.9 covers the mechanics. The same total severance dollars can land in December or January with completely different tax outcomes, sometimes a difference of $15,000 or $20,000 of federal tax. Engage the CPA at Module 3.3 before you negotiate the final payment date. The bracket math conversation can change the negotiated date, and the date is one of the biggest dollar impact decisions in this whole map. Step E2 is the COBRA election window, and 60 days is the deadline. COBRA continues your existing corporate health coverage for up to 18 months after employment ends. The election window is 60 days from the loss of coverage date. Miss the window and the option is gone. You cannot elect COBRA retroactively after day 61. The COBRA premium math compared against the marketplace ACA premium math is a real decision worth working through, usually with a broker. Module 14.4 covers the comparison. The election doesn't have to happen on day 1. It does have to happen before day 60. The deadline is what forces the decision in time to act on it. Step E3 is the 401k rollover, and direct rollover avoids a 20% trap. 2 ways to move money out of the corporate 401k. Direct rollover, the corporate plan administrator transfers the balance directly to your new IRA or solo 401k. No tax, no withholding. The full balance moves. Indirect rollover, the plan administrator cuts you a check, which triggers a 20% mandatory federal withholding, and you have 60 days to deposit the full pre-withholding amount into the new account, or owe income tax plus penalty on whatever doesn't get redeposited. Direct rollover is the right answer almost always. The Roth conversion question, whether to convert traditional to Roth at rollover time, belongs with the fiduciary at Module 1310, not with the CPA. Step E4 is cash cliff management, and reserves built before exit cover the gap. Corporate paycheck stops on the known exit date. Coaching revenue will not replace it for months, typically 4 to 12 months for a coach who hasn't been actively building a book on the side. The cash flow gap between those two events is the cliff. The methodology for sizing reserves to cover the cliff is in Module 16.5. The size depends on your monthly burn rate, on how much coaching revenue is realistic in months 1 through 6, and on what you're willing to draw down from other reserves. The decision is yours. The methodology gives you a worksheet to run it through. David is the kind of corporate exit scenario the bracket math punishes hardest. 180,000 corporate VP role, 90,000 severance offer, choice of December payout or January payout, same total dollars either way. December payout, 180,000 W-2 plus 90,000 severance plus 15,000 first-year coaching all land in the same calendar year. 285,000 of income at the top federal marginal rate, QBI phased out, state tax compounded on top. January payout, severance and coaching in the new year, partial W-2 in the old year, no stacking, 2 separate years of more reasonable tax brackets. The CPA conversation before the negotiation is the difference. Decision ownership matters at exit because different decisions belong with different professionals. Severance timing and bracket math belong with the CPA at Module 3.3. The CPA runs the projection across both calendar years and tells you what each date costs. The 401k rollover direction and the Roth conversion question belong with the fiduciary at Module 13.10. The rollover mechanics are simple, but the conversion math depends on your retirement projection, not your current tax situation. COBRA versus marketplace coverage belongs with the insurance broker at Module 3.5. They run the premium and coverage comparison. Cash cliff reserve sizing is yours with the methodology from Module 16.5. You know your burn rate and your risk tolerance better than anyone else. Pull 4 artifacts before going any further. Most recent pay stub, severance offer or expected terms in writing, COBRA eligibility notice if it's been issued, 401k balance and plan administrator contact. Save them in a folder named Exit Window. Engage the CPA at Module 3.3 before you negotiate the final payment date. The bracket conversation is the highest impact call in the entire founding sequence for an exiting executive. It can move tens of thousands of dollars across 2 tax years for the cost of a single CPA appointment. The whole rest of the map waits while those 4 decisions get sequenced.